Well, today I wanted to talk about house prices. We've recently revised our forecast for house prices. Up until then, we were expecting that between April, which was the peak in 2020, and June next year, the national price index was going to fall by 10%. And then over the next couple of years would lift by about 4% per year. We've revised that forecast to a fall of only 5% between April and June, and then a much stronger rebound, accumulating to about 15% over the 2 years from December next year. The way we're thinking about house prices is in 4 distinct stages. So the first stage is past, and that's the fall that we've seen in prices in response to the recession. So the economy contracted by 7% in the June quarter, and we've seen the house price index come down by 2.7% since April. Obviously a bigger fall in Melbourne, about 4.2%, Sydney around 2.7%. That 5% fall that we're expecting between April and June, we think that will be made up of a 12% fall in Melbourne, a 5% fall in Sydney, and only a 2% fall in Brisbane. The second stage that we're expecting is the one going forward, and that's going to be very much driven by the collapse that we've seen in interest rates. So fixed rate borrowing rates have now fallen from 3.65% on 3 years down to 2.35%. That's record lows since we've seen fixed rate borrowing in this country. And we've also seen a 60 basis point fall in floating rates, but now floating rates are more than 1% above fixed rates on average. I expect that prospects for fixed rates are very good. The Reserve Bank is committed to holding down interest rates. They have recently increased their facility to banks, whereby they can now borrow at 0.25% for 3 years, and that facility is now up to around 200 billion. And I expect that over the next 12 months, that facility could increase to nearly 300 billion. The Reserve Bank's been targeting the 3-year bond rate at 0.25%, and that's having a ripple effect right across all interest rate markets. And I think the Reserve Bank's made it pretty clear that their commitment is very strong to holding down those rates, and in fact possibly even increasing the size of the term funding facility and maintaining that downward pressure on the 3-year bond rate. In fact, there is chatter in the markets that the Reserve Bank could even do a mini rate cut to cut the cash rate from 0.25% to 0.1%. That's not our central view, but certainly the over-effective cash rate at the moment is only 0.13%, because that's the banks responding to the 0.1% that they're earning on their deposits with the Reserve Bank. So overall, the risks are that that cash rate could fall further. That would put further downward pressure on floating interest rates. So that's a very encouraging interest rate environment. And I think what it means is that apart from Victoria, where we expect house prices to fall in the December quarter, we expect that in the December and March quarters in the other states, prices will be relatively stable with some upside pressure. That's what I call the second phase. So that's the December quarter and the March quarter. The third phase, I think, is going to be the June quarter and the September quarter, when markets have to deal with the 240 billion of deferred loans that are currently on the balance sheets of the banks. That's about 620,000 borrowers, 180 billion in mortgages, and 55 billion in small business. So the question is, how will the banks deal with those deferred loans? How many of them will end up in distressed loans in the housing market and putting downward pressure on interest rates? It's our view that that risk will be well managed. There'll be restructuring of loans, banks will be patient, and I think that at that time there'll be some modest downward pressure on prices, but broadly speaking, the sort of fears that some have had, that phase will be a very, very negative phase for house prices, I think will be unfounded. And then, of course, we'll move into the period where interest rates will be at those record lows. The overhang of the deferred loans will be behind us. The central bank and the government will be focusing on growing the economy, not on constraining bank lending or on over-regulation. Now, that will be a very, very positive environment for the housing market. And that's that period of 2 years, beginning in December next year, where we see house prices doing extraordinarily well. We're looking for about a 15% increase. That would include 12% in Melbourne, 14% in Sydney, and 20% in Brisbane. In fact, the risks are probably to the upside, and the timing could be earlier. And that's because if people believe this story, they will tend to bring forward the good news. That happens in other markets, and I'm certain I think it's likely to happen in the housing market. So let's summarise. The fall in house prices that we expected of 10%, we think will now only be 5%, bottoming out in June. We think there'll be 4 stages of the process. The first one is behind us, a 2.7% fall in prices. And then we'll see slight rises, some flat markets. And then the third phase, which will be when the deferred loans come onto the market, which could have some small downward pressure on prices, but nowhere near as great as I think some people are fearing. Once we get through that phase, we think the situation for housing will be extraordinarily positive. Record low interest rates, stimulatory government policy, and no real restrictions on the supply of credit, unlike the situations we've been through over the last 3 years or so. Thank you very much.